Welcome to the One Academy Education Package, your guide to finding the right investment opportunities and to becoming a knowledgeable and wise investor. The One Academy Education Package consists of 5 levels, each divided into 2 to 3 chapters. We will cover areas such as financial markets, asset valuation, trading strategies, and portfolio management, and discuss cryptocurrency extensively. Our education materials will help you master the tools and skills you need to profit from trading on the One Exchange with tokens and cryptocurrency. What's more, our tutorials will introduce you to the exciting field of one of the hottest assets in the financial world, an asset that has been one of the most successful investments in the last years, cryptocurrency. The crucial advantage of our One Academy tutorials is that they are concise and user-friendly. We deliver the key concepts and have condensed thousands of pages of material in less than 100 pages per level. Our introductory level 1 will get you acquainted with useful background information, which will allow you to build your knowledge in the more advanced levels 2, 3, 4, and 5. Financial crisis wipes out the financial wealth of many investors and causes institutions to lose credibility in the eyes of the people. The world is still struggling with the global financial crisis that erupted in 2008. The unprecedented economic stimuli that governments introduced to combat the crisis due to cutting interest rates and printing money led major fiat currencies around the globe, such as the US dollar and the euro, to become less and less valuable. Currency-denominated assets, such as stocks and bonds, lost a significant portion of their value. Investing in such hard economic times requires investment choices that leave you on the safe side. Safe haven assets, such as gold and silver, have gained value significantly since the crisis erupted. You can protect your wealth and become prosperous in these tough times by following a bunch of simple rules and strategies. Always keep a very focused eye on what's actually going on around you. Even if the market is booming, everything can change in a matter of minutes. You should always follow the news and perform analysis about the assets you invest in. Use diversification. As wise men have said, don't put all of your eggs in one basket. Be sure to spread your money over a number of asset types, not just a single one. Optimal diversification includes not only traditional assets, but also alternative investment products. One of the best performing alternative investment products is cryptocurrency. Make sure you are saving money for emergencies. Keep yourself clear of too much consumer debts. Don't be lured to think there are no lucrative investment opportunities during crises. It is true that opportunities are harder to find, but the richest are usually those who invested at hard times when everyone else was saving. Don't panic when a crisis erupts. During crises, financial markets tend to overreact for some time. Keeping your portfolio might sometimes be a good idea, as it will rebound when the overreaction fades away. Risk is the uncertainty if the asset we invest our money in will reach the price we desire. The price might go up, but it also might go down. Risk is ambiguity. Risk is something everyone tries to avoid. When trading on financial markets, eliminating risk entirely is impossible. However, there are ways to minimize risk. Sometimes the risk you face might be higher or lower than you have thought. No matter the level of risk, however, always be sure to make rational investment decisions. Risk can come from a variety of sources. It is a combination of different types of sub-risks. Identifying the types of sub-risks and approaching risk according to its source is a key rule when speaking about managing your trading portfolio. Return is the reward you get for investing in a certain asset. Return and risk form the fundamental proposition of finance. The higher the risk, the higher the return, and vice versa. The main goal of investing is to get a high return on investment with the least possible amount of risk involved. This goal can be achieved by adequate portfolio management and balanced diversification. Cryptocurrencies have had a very good risk-return profile in the last years. Of course, there are always situations where returns can be abnormally high or abnormally low, compared to the risk you are taking. However, abnormal situations are neither easily predictable nor sustainable for long periods of time. Risk can be categorized under two broad notions: systematic, non-diversifiable, and unsystematic, diversifiable risk. Systematic risk, also called non-diversifiable risk, is the type of risk that stems from market events that are beyond any control of the investor. Systematic risk directly affects our returns. Several different components of systematic risk can be outlined. Market risk. This is the risk that is related to the rise or the decline in the movement of the whole market. If the financial markets go down for some reason, due to a global event or an act of terror, it is likely that your portfolio will also go down, regardless of how well you have diversified your asset holdings. Liquidity risk. Liquidity is a key concept in finance that every investor should know. Liquidity is how easy a particular investor can sell his assets to another market participant at the price he desires. The more traders on the market, the higher the liquidity. Accordingly, the less liquidity, the higher the risk that you cannot sell your asset and get cash in times of need. Systemic risk is the risk of a domino effect. In today's interrelated and globalized world, the failure of just one country or a bank can affect the whole world economy. Non-systematic risk is the type of risk that is directly associated with the asset you are trading. For instance, if we are to take stocks of a company that you wish to invest in, then its levels of debt, the competition it faces, etc., impacts its riskiness. Non-systematic risk is also called diversifiable risk, since combining assets in a portfolio can help us minimize the type of risk or even completely eliminate it. If you place your stock with other stocks, bonds, and gold in a portfolio with the right proportions of each asset, then the diversifiable risk cancels out. The most important subtypes of diversifiable risks are business risk. This risk involves the operations of the company that directly affects the value of the investment. For instance, if a company has trouble with the deliveries from its suppliers, then its sales and profits will be affected, and thus its stock price will go down. Financial risk. This risk involves the financial stability of a company. For instance, if a company uses too much debt to finance its operations, then there is a risk that it might not be able to repay the debt. Industry risk. Almost every company has some kind of competitor, and the actions that competitors make affect the profitability of the company we have invested in. Regulation risk. This risk involves the negative effect to our investment because of new laws and regulations. Default risk. This risk involves the probability that a company that issues stocks or a country that issues bonds might go bankrupt. Knowledge and expertise risk. Besides the uncertainties that surround the asset you invest your money into, the single most crucial thing for how successful you are is you. Simply knowing stuff will not help you much. You have to be able to make inferences, deductions, and conclusions by interrelating all kinds of information you receive. The keystones in diversifying your own knowledge and expertise risk include: never overestimate yourself. Never underestimate the market. Always do comprehensive analysis of an asset before investing in it. Remember to be self-disciplined. Never be greedy or overconfident.